We decided that we'd take a nice long look at the 100-page odd management report into JP Morgan's huge whale loss that came out earlier this week. And we found, we already knew that they weren't looking particularly smart, but it looks even worse. Agnes, I mean, one of the first things we saw was that they were relying on multiple Excel spreadsheets and they'd copy and paste formula between them, which, that's pretty worrying.
It's pretty worrying, I mean, again, A, because it's very amateurish, but also because they're dealing in particularly sophisticated credit derivatives that are illiquid.
Well, it's actually, I mean, it's worse than that, because you know, they had a guy build this spreadsheet and then nobody really checked it, and it turned out not only
well, they build these multiple spreadsheets.
Well, so not only is it very clunky, but it hadn't been tested really properly at all.
Right.
And also, let's step back from the fact that it was all these credit derivatives. This unit, which is running these weird spreadsheets, was responsible for managing the excess liquidity on the balance sheet, deposits which weren't being used. So $300 billion odd of money meant to be managed to minimize the bank's risk was done using manual input by people who didn't know what.
Well, and more to the point, it was done using, at least in part, synthetic credit derivatives, which are, they're instruments that can be modeled, but the models involve a lot of subjective assumptions and a lot of theory that you can argue is flawed. I mean, we had the famous David Viniar thing from.
Would have nothing to do with this. I mean, historically, I mean, this office is about like interest rate risk, like very kind of plain vanilla things. Looking at like what's at risk for the firm overall. So the fact that they went so heavy into, I mean,
and they did it why? I mean, they say as a hedge, but basically, I mean, do you really hedge a cash position using? And your lending, your basic bog standard lending by using pretty illiquid trade.
I think it's pretty clear that they were trying to do several. One of the problems was they were trying to do multiple things, but one of the things they were definitely trying to do, and traders were trying to show their superiors they were doing, is making money or minimizing any losses. So that's one thing, and then they're trying to reduce risk-weighted assets, which is a regulatory thing. So. Having risk-weighted assets are expensive to hold. You have to hold capital, so you want to reduce them. But there's a lot of suggestion, at least between the lines, that they were going to change the model rather than actually changing the trade.
Thing, right? They changed the model, saying, well, one of it was there's just not that much volatility on this value at risk model, which JP Morgan admittedly created, but which they have long since, talking to their investment bankers, their traders, they say, VAR is kind of irrelevant these days. But they relied on that. They said there's not as much volatility, and then we'll change the model.
But I mean, I think too, it just seems to me, it's like this office never really grew up with the rest of
exactly.
Right? I mean, after the crisis, JP Morgan, it absorbed WAMU, Bear Stearns, and there were, as you said, there are a lot of excess deposits now. I mean, I think the deposits more than doubled. From 2008 to 2009, and that's the thing. It's like no one just took. And this is this is a fault for diamond.
But I think some of that.
No one took a big picture. Look at this and say, wait a minute, let's take a look.
It was left with Andrew running it since 2005 with no real oversight. Every other manager was moved around apart from that.
I think this could be something that's to some extent unique to JP Morgan or big banks that have this sort of pool of extra deposits. But if JP Morgan's the best there is, then you have to wonder about the rest of the industry worldwide, really.
Exactly.
And I feel like that was always the issue with the whale, right? It's like JP Morgan was supposed to be the best, and yet they were able to make a mistake like this, and it was so crude and amateurish, right?
Okay, well, absolutely. Well, thanks, guys. We do recommend you dig into that report. It's full of some wondrously worrying insights into how the bank wasn't run properly. We'll be back next week after the long weekend break.